Hey guys, so I just wanted to do a bit of a tutorial for the newcomers that are getting into crypto, or people that are perhaps new to TA and don't have much understanding about charts or TA. So I'm just going to run through this PowerPoint and hopefully give some insight out to people that are lacking that knowledge in the market. So, as most of us know, a chart is a way to display and track data. So that may be a certain statistic we're trying to measure, or in this case, we're using a chart to measure and follow price. So this might be a chart that most people are used to seeing. So obviously, price up, price down, price up, price down, price up. And we use these to measure just about anything that has notable data, right? So a chart allows us to see different points of where price has been at different times. So when we're using technical analysis, we look at a chart made of what are called candles. So candles are these funny looking things here with the large stems to the up and down, the green and red bodies. One candle represents a section of time. So what I mean by a section of time is if you have selected on your chart, let's say the 1 hour chart, one singular candle, that's a terrible circle, one singular candle is 1 hour. It represents 1 hour of time. So you can see that in this chart, there is obviously quite a few hours that have passed. So how that is relevant is basically the higher the time frame that you're on, the more significant the levels are going to be that you're looking at, and depending on what time frame you're trading on, is how those levels are going to affect your trades. So we're going to look at candles. A candle will either be green or red. The green candle represents that price has closed above the open price, and a red candle represents that we've closed below the open price. So what that means is this candle has finished. So the hour, we're going to use the hour time frame. The hour has finished, it's up. Now this candle opened right here. So if price has pushed up above the open price, we're going to have a green candle or a bullish candle. So if price is opened here, this candle is finished after an hour, this candle opens and price pushes below the open price, then we're going to have a red candle, or what's called a bearish candle. So now we'll take a look at the contents of a candle. So why it looks like what it looks like. So the body of a candle, so this bit here, not these stems, these wicks as we call them to the upside, just that inner section, is the difference of price between open and close, right? So if we opened here at $10,000 and sellers push the price all the way down to 9.8K and the hour's up and we closed here, that is our body. So a new candle is created once the time frame countdown has hit 0. The new candle opens where the last candle closed, as I was explaining before. So we're going to look at the wick now, and I'm going to explain a bit about the wick. So the wick of a candle represents where price has been within the time frame of that candle. However, has closed in at a different price level. So like I was saying before with the bodies, if we open here at $10,000 and we close here at $10,200, that's our body. Now what can happen is if we open here at $10,000 and buyers pushed the price all the way up, but then sellers came in and pushed that price back down within that time frame within that hour and we closed here, that's going to give us a wick. And that's the same for the bottom side as well. So if we opened here at $10,000, sellers pushed the price all the way down to here at $9,500, but then buyers came back in before the candle closed, before the time ran out, and we settled at this level, and that's where it's going to close. So we use candlesticks to identify different formations. This is called candlestick analysis. Because markets are driven by humans and their emotions, this is displayed on the charts. By identifying certain formations, we can gather probabilities of what to expect from price next. So if we're using candlestick analysis, we can see that price has come down. We were trending down. Now, if we spotted this candlestick formation, which is called a morning star, that is a bullish reversal candlestick formation. So if we can spot that on an area of support, like this, let's say this is support, we're coming down, we spot this pattern, we enter at this level, probabilities tell us that this is a bullish pattern, and probabilities say that we're going up. So what is TA? Right, so technical analysis is using tools and indicators to find opportunities in the charts, right? So by identifying patterns, levels, and areas of interest, we can use probabilities to give ourselves an edge when entering or exiting the market. So this is a common pattern. We've had price push up and then sellers pushing the price down, and we're staggering down in what looks like a flag, right? So this is called a bull flag. So we've had our push up from the bulls. Sellers are trying to recover and retrace, push the price down. And then once we see this break in the top of the bull flag, probabilities tell us that price is going to continue back up. So this is called a continuation pattern. So this is a really good example of trading between support and resistance. So we can see this is our resistance level, right? Price come up, respected, went back down. Respected support, went back up. Respected resistance, came back down. Respected support, came back up. Didn't quite make resistance, right? Came back down. What do probabilities tell us? We're coming back down to support. We know that this is a strong area, as we can see previously, here and here and here. So probabilities tell us that price is going to go back up to resistance. And we can also see with candlestick analysis that we have a morning star formation here as well. So now we're stacking up confirmations. One of my favorite patterns to trade, an ascending triangle. So we have price coming up, hitting resistance, creating a higher low, hitting resistance, creating another higher low, and then we wait for that break in the pattern, and probabilities tell us that we're going back up. This is a bullish continuation pattern. So you can see sort of from those examples how we use TA and basically how we can trade the patterns that we see. So by using technical analysis, we can identify swing highs and swing lows. This enables us to enter or exit the market at a more ideal level. So learning TA, not just for trading, I believe it's really good to learn if you're just in the market in general. Learning charts is gonna help you immensely. So say you're a hodler and you can identify the swing. So we know that price bottomed out here, starting to swing. Maybe you gain an entry somewhere here, okay? You'd ride up the swing. This could take months, depending on your time frame or your strategy. And then once we identify using candlestick analysis, another TA, the top of our swing, we would be looking at exiting our positions. So you can use TA to identify your swings if you're a swing trader, or even if you're holding. So if you are a trader, you can also use TA to identify shorting opportunities, which allows you to make money on the way down. So as we can see in this pattern, we would have came from a downtrend and we're starting to form what's called a wedge. Now this is called a rising wedge, and this is a bearish continuation pattern. So we know that once we break to the bottom side of this pattern, after we've hit resistance typically, then we can expect price to come back down. Now, shorting the market is something you can take advantage of when you're a trader. So this was actually a trade that I took a few days ago, which played out, no worries. So it's important to understand that technical analysis is best used to trade with the market and not to make outlandish price predictions far into the future. Now, how many times have you seen in a Facebook group, page, whatever, crypto's going to 100K by December 2021, which obviously didn't happen. It's going to the moon. This is what's going to happen in 2 years, 5 years, 10 years. We don't use TA to make those sorts of predictions. If you're a trader, you're using TA to trade with the market, right? So we're gathering probabilities, we're gathering confirmations to tell us, which direction price is likely to continue in, and we're exploiting that, and that's how we trade, right? So things like fib levels, candlestick confirmations, patterns, trends, stacking up those confirmations to give us the best probabilities with a trade. So I hope that was insightful to everybody that's watching, especially the newcomers. If there's anything that you think I could touch a bit more on, anything you don't quite understand, please just drop me a message, give me a shout. Don't be shy. Always willing to help people in the community. And if you'd like to see some content on some other stuff, or something that you really want to know a bit more about, let me know, and I'll see if I can whip something up. Thanks, guys. See you later. Happy trading.